GetCrack. Wake up, motherfucker.
The U.S. blacklisting 50 Chinese companies from receiving American chips and saying they'll crack down on smuggling or chips sent to other countries that are making their way into China. Let's bring in Dewardrick McNeil. He's managing director and senior policy analyst at Longview Global and a CNBC contributor. Dewardrick, investors are naturally jittery because this is a huge market for NVIDIA chips, both in terms of what we actually know and how they might be getting there. So how big a deal is today's news, do you think?
Well, I think it's certainly something that investors should keep an eye on. What it says, Kelly, all of these actions, the Chinese actions as well as the ones announced earlier this week by the U.S., what it says is that the chip war, Kelly, is still on, and that the Trump administration still sees a need to continue with what I'm calling some policy continuity with the Biden administration to try and prevent China's chip industry from developing, the maturation, and to try and keep a performance delta between what the U.S. is doing and China is doing. But China is fighting back aggressively, as we've seen with the DeepSeek story here over the last several weeks, Kelly.
So is this all kind of posturing and the demand will ultimately be there and NVIDIA will have a lot of opportunities there in the long run? Or do investors need to rethink just how big their market will be?
Yeah, look, I think this is about a $17 or so billion market as it currently stands for NVIDIA, but I would not expect for that type of market dominance to remain over time. The Chinese don't want it. The Chinese may not need it. They have certainly figured out a way, we think, to do some of this as just good enough. So less energy, less compute power, but still pretty efficient for its AI needs, Kelly. So I think the future here is not that long. And so I do think investors should start to think about that.
Do you think, Dewardrick, that DeepSeek is entirely it's not real, but as they say it is? Or do you think there might be a little, fibbing going on here about the cost and capabilities?
Well, I think that's certainly a question, Brian. I'll tell you something else that's being discussed. Now, this could just be wounded egos, but if you talk to a lot of people here in Washington, the view is that there was some technology diffusion that went into what we see here. So taking some of the U.S. advanced chips that have been moved through these third-party loopholes in place to get to some of those achievements. And this latest action by the U.S. is intended to shut down that back door. So I think the debate is still out, but certainly I think we are at a place where DeepSeek is real, regardless of how they got there. And I think it's going to challenge the West for sure.
Dewardrick, what other risks do you see more broadly for U.S. firms in China, if any? I mean, look at the summit that was just held to kind of court global leaders, and Tim Cook was there.
Yeah, look, I think there are a lot of risks still on the security side. Again, I come back to this announcement this week. The policy continuity here, I think, may shock a lot of people, but there are a lot of people in the Trump administration who still believes that the technology war, the chip war, which was started by Biden, could be ramped up with Trump because they still want to prevent this technology from being used on the battlefield, Kelly, where a few nanometers can make all the difference for targeting, communication, and autonomous decision-making in the battle space. So I think this space is going to remain a hot and contested space for a very long time, and investors need to be aware of that.
All right.
Let's go to oil. Miraculously, that idea that this was demand and this was demand is paying off. We are still moving up. We're trying to stop. Still some kind of impulse, less so than the previous one, but on slightly lower volume. So relative to the distance that it moved, it's the same. More supply is coming in, still holding. I'm thinking, like, could we possibly have some kind of rally? And that's going to be stronger than this one right here. So I'm not expecting like the reactions like this. Some reactions, but not with that high volatility, because volatility generally here in this area compared to this one is quite different.
Getting through the day, huge LNG targets, in particular of how much it's going to make up in terms of your business, 20-30% larger by 2030. How do you get there?
Yeah, thanks, Alex. Look, we're very proud of where we are today. Today in the Capital Markets Day, we took a pause and reflected on the journey we've been on over the past couple of years. And the key message was one of trying to instill confidence. Here's a company that has delivered what it said it was going to do and actually over-delivered in certain areas. And beyond that, as you rightly pointed out, we've also today laid out a vision out to 2035 that has LNG at the heart of it. We believe LNG is going to be a critical part of the energy system, and we want to be the leading player in LNG. But our story also has lots of richness around wanting to sustain material liquids production and being the most competitive and the most focused energy marketer and energy trader in the world. And so a holistic story that I think we're very proud to be able to say is well on track.
Are you worried at all about a potential looming LNG supply glut and kind of betting really big on this for the next 10 years at a time where there's just too much supply coming online?
Look, in my job, I have to look at 20 years. And what I see when I do that is up to 2040, we see a potential 60% increase in overall LNG demand. We have a diversified portfolio, both of production sources as well as demand options. And we are very much looking to leverage that global diversity of production and customer contracts to be able to create value. Importantly, our LNG portfolio is heavily linked to long-term contracts that are tied to Brent, which means we have a lot of resilience. And so we can ride out the inevitable cycles in this business while making sure that the underlying cash flow continues to come from this business.
So what should investors look for in terms of the capacity increase on your LNG output?
Very much what we outlined today, which is 4 to 5% per year, so indeed the 20 to 30% by 2030, and that's just to 2030. We see more running room beyond that. We have projects that we can evolve over and above that. But what's unique around our LNG business is not just the production piece. We are actually also selling roughly the equivalent amount, not just of what we produce, but also another equivalent amount to that. Because we're also one of the largest optimizers of LNG in the market. And so in any year, we're selling around 60 million tons of LNG, which is significant. And so we are trying to continue to build up our portfolio to really have that diversity and to be able to make sure that we can continue to essentially stay in the 15 to 20% of the overall LNG market is what we represent.
So once you get to 2030, what actually happens to the oil side of this business?
So we have a very clear pathway to sustain our liquids production to the tune of around 1.4 million barrels per day between now and 2030. And we have plans to extend that plateau well into the future. So we already have plans in place for that. And so the key areas where we see growth at the moment are our integrated gas business, as we've talked about, LNG, but also I would say our marketing business, our mobility business, which is the leading franchise in the world, our lubricants business, which is another core part of our overall value proposition. So those will be growth trajectories, and our sustained liquid production will allow us to have the fundamental underpinning that continues to keep us as a scale company overall.
Sustained liquids doesn't sound like growing oil production. And you know this is my way of asking about, you guys don't have Permian assets.
So what we have is a very diverse portfolio. We have the largest position in the Gulf of America. We have the largest position in Brazil, which are the two premier deep water basins in the world. Right? It requires a lot of running just to stay flat. So these portfolios are declining anywhere between 4 to 6% per year. So one has to stay running fast just to stay flat. Beyond that, we will look at opportunities, and we will continue to look at those opportunities. But of course, we've left the Permian, and we believe that the opportunities we have in front of us in the Gulf of America, in Brazil, in many of our heartlands like Kazakhstan, Oman, Malaysia, those are the places where we want to continue to strengthen our portfolio.
The analyst notes about today were all relatively positive. RBC said a really nice quote, said, "Today reads as more evolution than revolution." And I'm wondering if the revolution part is what investors need to see to have Shell shares start to outperform the likes of Exxon as well as Chevron. And would that evolution be buying a U.S. gas producer, doing some sort of substantial oil deal?
I think there's a couple of dimensions to that question. I'm very pleased with the evolutionary nature of it, and it's important that one footnote in all that discussion is that we have bought back around 20+% of our share register over the last 3 years. And a big part of what we announced today is we will continue to preferentially lean towards buybacks, having indeed increased the overall distributions to 40 to 50% of our CFFO. On this trajectory that we're on, we will have quietly bought another 40% of the company by 2030. To me, the revolution is not in singular actions. It's in looking at the life cycle over a period of 7-8 years. If we can buy more than half of this company, that is what is truly going to be differentiated and transformational for our shareholders.
So, while I do want to ask you, though, about just the general structure. I mean, a lot of in terms of the cash giving back, there has been a lot of discussion in analyst circles about this idea of why we haven't seen more balance between the dividend versus the buybacks relative to some of your competitors.
Yeah, it's a great question. I think the first thing I keep getting asked is, can you grow your overall share of distributions? And thankfully, we've been able to move from 20 to 30 to 30 to 40 to 40 to 50. So big tick there. Then indeed, it's the balance of how we want to return capital. It's a point that you both made earlier, which is we still find that our fundamental valuation does not fully price the cash flows we see into the future. So what a great opportunity to be able to use every marginal dollar of distributions to be able to buy back our shares and create that life cycle value for our shareholders. By the way, we have increased our dividend per share by 25% over the last 2 years, and we have a 4% progressive policy around our dividends. So we are addressing the dividend, but today the right capital allocation option is to go into more buybacks, and that's what you see us doing.
Investors also, have also, I guess, pondered, if not asked the question about your listing. Obviously, your primary listing overseas. You're standing there on the floor of the New York Stock Exchange. Has there been any sort of meaningful discussion, thought, consideration about making the U.S. your primary place of listing?
There has been, and indeed we made the decision a couple of years ago to move our listing our headquarters over to the UK. At the heart of it, our focus is to make sure that we are driving the fundamentals up. To me, that means growing the free cash flow of the company. Yes, listing might add different liquidity, but we're already very liquid here in the US. Over 50% of our shareholder base is a US shareholder base. So we are attracting many of the investors that believe in the investment thesis we have. And so while we focus today on making sure that we're pulling every lever to build consistency, to build resilience, and to build longevity, of course, we keep all options open. Right now, a change of listing is not a live discussion, but it's always under review, and of course, we'll look at it when the time is right.
It feels like a no for now. I'm just going to paraphrase that. Going back to M&A for a moment, you're going to love this question. But when it comes to, say, BP, I know you get a lot of questions on when, if, how are you going to buy BP. But I want to approach it from another angle and talk about synergies. A big part of your outperformance in the past couple of years has been synergies and weeding out those costs. At what point does BP become so cheap you just cannot avoid looking at them for those synergies?
Alex, you'll forgive me if I don't directly answer that question, but what I will say is our focus over the last 2 years has been to build fitness and strength for Shell. Right? Today, people are asking the question because they see a fitter, stronger, more dynamic company. And that to me is great. We want to be able to build flexibility. We've been able to bring our net debt down to essentially the lowest it has been, excluding leases, for over a decade. We've been able to outperform our peers in the sector on both TSR as well as just pure share performance. And we are generating free cash flow in a very robust and solid way. And so today we have options. At the same time, when we think about those options, the priority is to deliver that 10% free cash flow per annum growth within our business. That's immediately within our control. And of course, we will keep an eye out for opportunities, but I have to say the bar is high. Because if you're going to go for a big acquisition, one has to recognize that that can potentially distract, and therefore we're very focused on making sure if we do something in the inorganic space, that the bar is high and that we go in ready to do that.
That also kind of felt like a no. I'm just saying, from where I sit. Yeah.
I would qualify it, Alex, as it's finding the right time to make the moves in what is a long journey for us.
Okay, but is BP like on the road to the moves, or is BP like on the highway somewhere that you're not passing?
What I would say is we are always looking at companies both in Europe and beyond, and every company will have its time, and at that point we'll make a decision.
All right, well, I'll get you off the hook here and give Alex a break for a second. I do want to get your thoughts, though, on just broader economic conditions globally. And I have to ask you, of course, about what's going on here in the U.S. politically. And I know you don't have a lot of exposure to assets here, but obviously what we do here has ripple effects across the world. Have you actually had a chance to actually meet with anyone from the administration, including the president?
So firstly, just a correction. So our biggest capital employed globally is here in the U.S. We are the largest producer and operator in the Gulf of America. We are the largest off-taker of U.S. LNG of any company. So we have a very material presence, not to mention 13,000 staff that are very much the core of our company here. I have had the opportunity over recent weeks to indeed meet many in the administration, including the privilege to meet the president. And what I would say is we are very encouraged and welcome the strong support for the energy sector, not something that has always been there in the US or beyond. And I do think the energy sector is a critical underpinning of any successful economy. Beyond that, what I would say is what is key for our sector, for companies like ours, is predictability in the investment climate and the stability of the investment climate, because many of our investments have payback periods usually above 7-8 years.
Yeah.
And so that is a critical part of being able to have the peace of mind to make the material investments that we need to be making.
Well, before we let you go, if there is a peace deal between Ukraine and Russia, are you anticipating Russian gas flows to Europe, and how are you seeing the global flows here?
Difficult to call where that ends up playing. I mean, what you find, of course, is Russian gas to Europe has gone down from roughly 40% of Europe's demand to just under 10%. So potentially some flows will occur. What we are focused on is making sure that through our world-leading trading capability that we have, that we are managing all these potential discontinuities that we are seeing in trade flows. And so we want to make sure that we can deliver to our customers. How the situation in Russia evolves is anyone's guess, but we are preparing for multiple different scenarios so that we can honor those trade flows that need to be met.
Well, we really appreciate you taking time for us. I know it's been a long and busy.
All right. What's up, guys? It is March 26, 2025. So I think we are at a turning point for oil. I'm going to wait for natural gas a bit. Let me replay the oil video again. So this is the update from the Wyckoff trading guys. Okay.
Let's go to oil. Miraculously, that idea that this was demand and this was demand is paying off. We are still moving up. We're trying to stop. Still some kind of impulse, less so than the previous one, but on slightly lower volume. So relative to the distance that it moved, it's the same. More supply is coming in, still holding. I'm thinking, like, could we possibly have some kind of rally? And that's going to be stronger than this one right here. So I'm not expecting like reactions like this. Some reactions, but not with that high volatility, because volatility generally here in this area compared to this one is quite different.
Okay, all right. So let's look at some cycle analysis for oil. Let me give you that. Let's go look at some cycle analysis for oil. Let's see. Blah, 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 blah. Okay. All right. Here we go. Oil. Let's see. Check the state here. Calendar days. All right. Update it. Okay. So, yeah, we're near a bottom, or we could already be at a bottom here at this cycle. Should move up into May. All right, so this might already be starting to move up. So I think April we might just be already on our way. Let's see. Yeah, Yeah, looks like it. Looks like it. So, and then we'll move up into July. All right. Usually 4th of July, you'll peak out there and then you'll start rolling over in August. All right. So that's what I'm looking for. So let's see. Yeah, let's wait for that. And then let's look at the dollar right now. Let's see what the dollar has for us. See if it's set correctly. Okay. I think the dollar is going to rise. Yeah. I think we've already hit a bottom. It's going to rise. Now, is that a good thing or not? Hard to say. I think if you listen to Samantha LaDuke, she thinks we're in a different regime now where higher dollar might technically be a good thing because that means Europeans are coming back to buying U.S. stocks. How that affects commodities, that's a different story. So that's a tricky one. All right, we got gold still banging its head on 3,000. Okay, I don't know how this affects. I think silver is back at $28 an ounce. So yeah, that'll be something. That'll be something we'll have to look into. Okay, guys, that's it for the cycles. Let me play this copper video here. We got, and there's a longer video after this one, but I'll hold off on playing that one. Here, let's see what they say.
The US tariffs on copper imports could come within weeks, which would be months earlier than the deadline for a decision. That sent copper trading in New York to a record, with the metal since paring some of its earlier gains. For more, let's bring in Bloomberg's Brian Fowler with the details. Brian, what could be the global impact then of these copper tariffs? We've seen the divergence, and dramatic as it has been, between the pricing in the US versus here in the UK, the LME. The global impact of these potentially 25% tariffs on copper.
Yeah, I mean, the bottom line is inflation. So as you said, copper was at a record. That's partly because of output stoppages in Chile, but really it's because of notions that these tariffs will kick in a lot earlier than previously thought. And so we've got a lot of companies rushing to get ahead of those duties by front-loading those imports. So there's a supply squeeze in the U.S. As we heard earlier in the show, U.S. prices are higher than they are on the LME, and that puts a lot more pressure on U.S. manufacturers. We've already seen that U.S. manufacturers are paying more for aluminum and steel and other building supplies than their counterparts overseas because of tariffs. This would, of course, increase that burden on them. So we could see U.S. manufacturing lose some of its competitive edge for a short term. The long term, of course, the hope from the Trump administration is that the tariffs will encourage more producers in the U.S. to boost output, and that would reduce the reliance that the U.S. has on overseas suppliers, especially China. But I think, it's right now, it's especially a squeeze in the U.S., but if those tariffs kick in, at 25%, as you say, I think we're going to see inflation go global, really, for all users. And of course, copper is a ubiquitous metal in wiring for everything from houses and buildings to cars and machinery. So it'll hurt everybody.
All right. Good. So I think HB was playing FCX, that stock. So that was nice. That was a nice play. Okay, so we're gonna have to see how far things will go. I'm looking also at aluminum. I don't think I've seen anything. Also steel, I haven't seen anything either that makes me want to say there's something going on there yet. They've been in long-term ranges for quite a while. Okay, so let me share the screen once I get that up. Field day, copper's up. Yeah, copper's always up. Crackheads always want the steal copper, but it might even go higher. So that's what I'm wondering. Let's see. Okay. Especially if China's economy starts turning around, that's definitely will push copper up. So you got tariffs and China demand and manufacturing. Yeah, that'll be something. But I don't know. I don't know if the global economy is going to be healthy enough to lift things that high. Gas and natural oil, yeah. Coal, yeah. So energy, yes. Copper, not 100% sure. I think a lot of that also has something to do with the AI expansions and things to make more wiring between power supplies and power sources into the data center. But you know that AI story is always a little iffy. Okay, let's see what I gotta do. FCX is the one, right? Yeah. Let's see how that one's doing. Yeah, so we already hit a peak. So I think HB was already selling. I don't know how much he was selling along the way up here. I think he bought along the way up here. So he's probably done with it now. So I gotta see. Yeah, I'm kind of wondering if we already hit a peak, a local peak, and I will wait a while if I were you, because we've been in this range since 2021, as you can see, right? Yeah. Okay, let me push that in. Push this out. So we've been a long range. Down, up, down, up, down, up, down, up. Right here. We're still in it. If you look at the COPX ETF, COPX, same thing. So it's mostly driven by FCX anyway. That's the mainline company. If we look at steel, SLX ETF, you see this still in a range. So I don't see much anything either. It's just going up and down like this. Now, if we look at oil and gas producers, range right here too. This one since 2022, right around May. So we hit a bottom here again, or we're going back to the top, I guess, over the summer. Okay, XLE. So this is a general energy. So it has solar and other things too. Same thing. It's in a range. So it's mostly controlled by XOP. And then FCG is the ETF for natural gas stocks, also in a range. All right. Now, let's look at specific stocks. All right. Let's look at specific natural gas stocks. EE, Accelerate Energy. See, this one looks a lot different, right? It went down to 14, went up, back to the 30s. Now it's trying again to get up. So this was around this week so far. We're up 7.88%. Let's see, EQT Corporation. Same looking structure, right? You see it's been going sideways, then it's bounced up. This thing was already moving up since the summer when natural gas was moving up. WMB, another one. A lot nice. Yeah, this is very nice. This is a lot nicer. Okay, and then we have LNG, Cheniere Energy, right? Similar. They're all similar. So keep those stocks in mind. And also KMI is another one. Yep, similar one. Kinder Morgan. And then you have another one like BKV. All right, I didn't put this in the list, but this is an IPO type stock here. Utility in Texas that does mostly natural gas. So it went all the way up here to 26 from 18 and went back to 18 and is bouncing off of there. Now, I'll just be watching it. I don't know if it's a good idea to do anything big on this one yet. But if you got it at 18, it's no problem to keep it there. But if you want to add right now, I'm not sure. KMI, yeah, it looks better. Now, ET is a pipeline stock. So it's a bit different from the other ones I've talked about here. And so BKV and ET, a little bit different. ET is pipeline. So they just transport the natural gas and the oil, and BKV is the utility. So a little different from the other ones, which do more infrastructure support and selling of natural gas itself, something like that. So they all have their little places, but you can see the difference. You can see the difference in a lot of the charts. All right. Now, do uranium analysis. Oh, uranium, man, uranium, terrible. Let's see. URNM is the ETF for miners. We're still in this range since 2021. If I was going to play it, I'd rather see if the infrastructure for uranium is going back up. So let me see. Okay, let's see. Which one I talked about? Black Suit of 5 was talking about these ones. I still haven't decided if they're any good yet. Oh man, these guys are so volatile. VRT is, oh my god. Yeah, this is not really uranium, but they do infrastructure, so I guess I'll put it there. Or is it VST? I keep forgetting which of these. One of them is liquid cooling and one of them is damn uranium or something like that. Let's see. VST stock. Which one did it? Blah 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 blah. VST. Yeah, power generation in Texas. So do they do mostly uranium or what? They do natural gas, nuclear. Yeah, they do some nuclear. I don't know how much percent of their business is nuclear, but they do some natural gas. That's good. But yeah, like I said, like once it got this huge blow off move up here, it bounced down to 105, going to 137. Okay, just hold on. Yeah, I wouldn't be in a rush with this kind of chart. GEV, this one definitely is uranium, mostly uranium. So GE Veranova, the when they split off between the whole GE companies into 3 different companies, this is one piece of them. So yeah, similar to VST in chart in terms of the chart. So wait a while. I forgot. Talon Energy also does uranium, nuclear energy. Wait a minute. Yeah, I think so. I think that this one does. Yeah, okay, blah blah blah. And what does it use? Mostly uranium or natural gas or what? Okay. Well, CEG I know definitely does it. Yeah, so it probably is similar. So CEG is another one. So TLN, Talon Energy, and then CEG is another one I liked. Yeah. So this one's similar, but you can see this chart's already completely collapsed, right? Big red candles here on the weekly. Now it's down below these 2 lines and then below the moving averages. So yeah, you got to wait. That's too much damage. You got to wait. Got to wait a while. Maybe later this year and come back because the uranium miner is already getting pummeled. And these other 2, LTBR, NNE, LEU, these smaller ones, yeah. These are like moonshots. They act like penny stocks basically. So yeah, you can wait. I don't think there's any hurry. There's no rush right now. Nuclear, yeah, there's no rush. Natural gas and oil, yeah, you should get running into them. And China, they're doing thorium reactors and stuff like that. So I think the uranium plays, wait for them to find their supports and their balance. You don't need to rush into them. Okay, let's see what else. So I did the natural gas. Okay, so I did some uranium, I guess, today. I didn't plan on it, but all right. Let's see. Let's look at some stocks I was mentioning before to short. AOI is down 10%. So if you're into shorting, yeah, like I said, ideally I would have liked it to go to 29 or 26 and then short it. But it looks like it's already rolling over from today. If the market does turn down badly by Friday, like really badly, AOI is the play to make. Oh, you do Yum. All right, broke genius. Let's see, Yum. I think YMM is Yum. Maybe I'm wrong though. Maybe it's Yum. Who knows? Okay, Yum is Yum. All right, so YMM. I never heard of this one. Full Truck Alliance. I remember that. Maybe you mentioned that before. I don't know. Who knows? Okay. Oh, interesting looking chart here. Yeah, I like this. All right, I'll put it on the list. Okay, I'll look at it again. Yeah, I like this chart. It looks good. Okay, I'll put it on the list of something to look at. YMM, Full Truck Alliance. Okay. All righty. Let's see. SOC is my spec play for oil. All right, let's see. See what's this one about. Oh, you like these types, huh? This is very it's kind of like that Indonesian one. I forgot what people love to play that one, like a meme stock. Indo, yeah. This thing that went from like $4 to $80 in like a couple seconds. All right. SOC. Okay, I'll put that on my list too. I don't know. Interesting looking chart. All right. Let's see. All right, put that one in there. So see what else we got. Okay. Not bad. So let's see. And Zhang Wei said TRGP for uranium 1. Let's see what that chart looks like. Okay, Targa. All right. Yeah, similar looking to the other uranium, natural gas plays. So if this is natural gas or uranium, I'm not sure, but let's see. All right, let me look it up. TRGP looks like a good chart. Very nice. Very nice. I like that. Okay, yeah, it's in Texas. Yeah, liquefied natural gas. Perfect. Yep. All right, I'll add that one to it as well. Perfect. Yes, this is nice. Very good. I like charts that look like this. These are kinds. So I'm sure there's others. I'm sure there's others that I haven't seen. There's so many of them that have similar looking ones, you know? So don't. Yeah, a lot of people would just be like, oh, let's just look at the top ones in FCG. Like you see this, it just goes sideways. I don't want charts like companies that go sideways or down. Like not now anyway. So yeah, definitely TRGP fits the bill. You want these types of stocks that were already going up in 2024 ahead of Trump, not because of Trump. So you see this was already moving ahead of Trump, and then Trump just pushed it up even further, right? So all the little tickers I mentioned for natural gas, they should be doing like this. They should be doing like this. This is what you want. This is what you want. All right. So that's a good sign because they were going up in anticipation ahead of natural gas demand. And if you look at the commodities for natural gas, right, it's been down and made a bottom around February. All right. Before moving up because of Trump. But the natural gas companies were already moving up. Why? Because people were already buying the future. They were already seeing where the future was going to be for natural gas. And natural gas is going to go up higher, I'm guessing. Once we get through this section here, so a lot of this stuff is because of the weather. We get a lot of blow-off moves because of the weather. And it's been very cold in the Northeast, right? I think you guys still have snow in the Northeast. So it's already starting springtime and you still got snow. So a lot of this volatile action was because of the weather changes, reports being changed. Usually they would be moving down. Yeah, they would be moving down because going into spring, it's already starting to move down. And then late spring into summer, then it'll start moving back up. But this year, we've been doing quite well. Okay, so we've been building this little base since 2023, since the 2022 Ukraine action here, the tariffs, everything, not the tariffs, I mean the sanctions. And then after that, we had mild weather, and then it just wound down. Everything went back. So that's how commodities move. They move fast up, and they'll move fast down. Yeah, once you collapse, you got to wait. Build the base, and then now we're ready for the next big. I don't know if it's going to go this high. Going up to $10 a million British thermal units is pretty crazy, but it's plausible. It's plausible. Okay, we'll have to see. Now, if you look here, this is just the futures contract. And what I'm going to do is I'm going to adjust for the contract rollovers. So now the chart has changed, and I'm going to take away the volume here. Okay. All right. So you see this chart? Now I take that away. I put it back to where it was. So this is if you don't take into account that you rolled over the contracts. So when you do the futures, this was, if you actually look at it, the low is in November. If you look at it this way, the low was in February, okay, of last year. Now, when you play ETFs like Boyle and KOLD and things like that, you see what happens? It looks god dang ugly. Because if you hold it for too long, you're going to get chopped up by the rollovers. So it's not good to hold this for too long. What you want is you want to be at the point where it's ready to rocket. Okay? So if you were here when Ukraine got invaded, okay, like this was just before it got invaded, right? February here on a Tuesday, 22nd. So that was the week before the invasion, I think. And then it started. Then it started moving, right? Then we got the action here, moving up. Yeah, that's where you want to be. You want to be here. So this was a crazy time. Now, Now, because of all the splits, I mean, I did not pay $3,000 a share for this thing. All right. Okay, so okay, let me take this down. Let me take this comment down. Yeah. So yeah, this is not. This is because of all the splits. So this split was 1 to 20. I think there were several other ones. I don't know what happened, but I definitely did not pay what 12,000 or whatever the hell it was. So we want to get to the point where we hit that level again, where we can start moving up in a steady way. And I mentioned Boyle like around the summer last year, so you could see, okay, around July, right? It started moving up a little bit, but it failed. Okay, it failed, and then I had to wait. We had to wait for November to try again. But this is not really the main move. This one from 42 to 98. This is pretty lame. Pretty lame for natural gas. You want the big one. Okay, you want the big move. So let's say Boyle gets down to 65 or something into next week or something, right? Or maybe April, like mid-April. I mean, not the first week of April, and maybe it'll just go sideways and go lower. Okay, I don't know. It's possible. Commodities be doing like that. And then what I want to catch it when it really wants to fly. So let's say you get to 50, then I want that 200% move up on this guy. Okay, at least. You never know. We could go even higher until the summer, right? So let's say it gets 200% from there. We could get to 170, 180, 190, 200, but maybe we get lucky, get a 300% move and 240 from here. I don't know, but that's what I'm looking at. I'm looking at that. Now, if you play futures, you're even crazier. But hey, you'll make more money if you play futures directly. You'll have more leverage. But good luck. Don't get chopped out, because this natural gas thing does not play nice. It's probably the hardest of all the futures to play if you're playing futures. Okay, so I think you got an idea of that. So that's why it looks like this when I adjust it for the rollovers in the contracts. When I don't, it looks more like the spot price. So this is what it actually should look like. But if you just bought and held the futures contract and kept buying the next month and roll over to the next month and roll over to the next month, this is what happens to you. You lose money because you're buying more expensive futures for the next month contract when you roll over. That's why if you play futures, you're not doing that, right? You're buying the actual future for the next year's contract or something to play long on natural gas, something like that. And maybe if you're more sophisticated, you'll know how to trade off different types of contract dates and contract prices and their movements to hedge, right? You can short the front months and then long the back months or something like that. Yeah, I don't know. That's beyond my pay grade. I can't tell you how to do those things. Okay, that's good. We covered that. All righty. What else? I have a ton of videos to play. Oh, GameStop. Let's quickly talk about GameStop, Carvana, and Mobileye. Okay. GameStop had earnings, and after hours, they announced share sales, new shares. So they had earnings, right? It popped, all right? It fought in this area here. And now after hours, I think it's back down to $26 because they've issued more shares. So I'm not necessarily saying you should play this stock, but it might be a good indicator. You know, okay, it went up a little bit again. So it's 27. Maybe it's around 27 right now. So it's still in this range, okay? So went undercut. It didn't really tap the 20. That would be the best place to buy GameStop. You buy at 20, you short at above 30, you go back and forth, because this is how it's been for a while now. That's the best place to do it. Short here, long here. And then, well, in this case, it never went anywhere, right? It took like nearly, looks like 7-8 months until it got back up to this point here. Yeah, shoot. Yeah, okay. Yeah, 6, 7, 8 months. Yeah. Okay, so it went back up here. It got back up, then it went back down. All right, yeah, it's still stuck. Now, I want to use this as a gauge of sentiment. All right, so you can use this as a gauge of sentiment. You could see how retail is thinking. Now, this could be a good place where you say, like, well, next time it gets close to 30 again, I might short it if I think the market's going down next week. That could be a play you could make. Yeah, you could make that play. You could use GameStop as one thing. I mean, I would rather do AOI or, yeah, AOI looks ripe. The next time it moves down and it crashes through 14 or 15 here, it could just quickly have a panic day and go down to $7, you know. And if you're playing options, you like the volatility. That's the thing, you know. I don't like that kind of shit, but if you're doing options, you want to be in stocks like this where it just completely moves quickly. You know, that's where you make the most money. You want it to go down as fast as possible. So this type of stock could do it. GameStop, maybe, you know, it might, but it might not. There's no guarantee. I mean, I'm sure there's a bunch of people that bought today trapped up here. They're issuing more shares. It might defend it tomorrow, right? It might go to Friday back up here, but that would probably be the time where I would be thinking, hey, I could short it GameStop at 30 and use that to short the whole market altogether. Because if you want to bet that the market is going down tomorrow, next week on tariffs, because new tariffs, reciprocal tariffs will be announced, retaliatory tariffs will be announced April 2nd by Trump on Wednesday. So that's 1 week from now. Okay, so if you want to bet on it, yeah, you could watch these. Another one would be LUNR, you know, interactive intuitive machines. You see this? It had earnings. I mean, here it was because like they couldn't land on the moon correctly. The thing tilted over, and then the earnings was just like a relief pop, right? It's just like okay, earnings wasn't bad, so we'll give you all the shorts. Probably got squeezed up here, up to this level. All right, this $9.75 level, which is important because this is when the SPAC IPO'd at $10 about. So you can see it goes around, it goes up, and then comes back down. It likes to go and touch this area before it does something. Now, I have my doubts that this thing would really get above 10 and fly up to 14, which it could do. I doubt it. Most likely, this will have a failed attempt to get to $10.95, or maybe even get a little bit above $11. And then from then on, it will just drop like a rock really quickly. So if you're playing options, again, you want that volatility, so sure. So you want to look for small cap stocks that you can short. If you think the market is going down, I would say, like, yeah, if it's cheap, if these things are cheap anyway. I don't know how the options market is for these, but I'm sure the puts, buying puts on SPY aren't going to be cheap compared to some of these lesser names. AOI is definitely not that popular, so maybe it is cheaper than LUNR. LUNR is too well known, maybe. So that's why I said, like, look around. Like GME might not be good either. So you have to shop when you do options. That's the painful thing. You got to look at everything and decide, well, which one has the best chance of getting me a good amount of profits for the risk I'm taking, right? Okay. Okay, let's see what else. Oh, Carvana and Mobileye. All right, Mobileye had an announcement yesterday. Some kind of deal, I think, with Volkswagen. So it's still stuck in this range. So I bought it at like 14, right? And I'm just holding it for now. I'm really not sure how far it's going to go here. I think it's going to drop back to 14, honestly. So I don't see a rush. Now, will it break 14 and drop to 10? That's something I have to worry about, even though I got it at 14. Yeah, if it comes back down from here to 14 next week, yeah, I'm definitely gonna be like, oh shoot, this is not good. So, but if you have it at 14, it's okay. You can wait and see next week. But it did have an announcement, but it didn't make it go far. The other one, Carvana. So Mobileye is MBLY. Okay, Carvana CVNA. All right, this used to be the darling, okay, of Wall Street. Very easy stock, because since 2023, it was just a straight, nice, smooth way up from 27 to 250. And if you bought here. I bought it here, but I sold early. I went from 4 to 17, right? I was like, oh, 4 to 17, great deal. I'm out. Yeah, I should have got back in. Even if I overpaid and bought here at 27, it would have made sense because this chart has been doing well. Once it got above this 22 level, it was like, yes, this thing could go up to 150 at least. So now it's doing this. It's testing this 222 area. If it fails here, comes back down to 155, guess what? It's just going to struggle here. And if maybe by next earnings, you know, it might be a great short. It could be. This could be the end for Carvana. Like, especially if the economy is turning around, right? It's like people aren't going to use their services to buy used cars. Hey, I think this will be one of the other things. So the first thing to look at was makeup, right? We looked at a lot of makeup stocks from last earnings. Terrible. All of them were terrible. L'Oreal, Ulta, you know, they were not doing well. The next one to fall would be cars. Cars definitely would be one. And then housing would be the next, right? Then you look at housing stocks. So all these things you have to look at for their level of importance. So I think cars will be next. If things are really rolling over, I think you should see some bad earnings next quarter or 2 quarters away. And that will be the end of this company, right, for now. And this thing could go all the way back to 22 from 200. I don't know. I'm just saying. I'm not a shorter, but I know some of you guys might want to, you know, make some money on the downside. You got to pay attention to some of these stocks that used to be good, right? That used to be good. You want to look at them and eye the chart and be like, okay, how does it react during the next earnings? What is it doing? Yeah. All right. That's it. That's all I want to talk about today. I don't think I want to review any other stocks. Well, let's talk about MSTR. So see what that one's doing. Let me quickly talk about this one. Yeah, it's still holding on. MSTR. Yeah, you know, Bitcoin did well today, even though NASDAQ was down to 2%, you know, S&P down 1%. Bitcoin was holding up. MSTR was not doing shabby. You know, it went down, but not as bad as it could have. Whew, it's holding it. So I did sell Monday and Tuesday, right, on the way up here. And I was really just thinking, should I buy it back tomorrow or Friday? Well, Friday might be too late. If the market is moving up on PCE data on Friday, it might be too late. I might not even take that chance. Yeah, then we got a weekend. And you know how weekends go. It could be something crazy. So yeah, MSTR, MSTX, let's see. Oh man, yeah, it's still holding the 33 area. Pretty good, pretty solid. My hope was like it could hit 45. I still have some leftovers that I didn't sell from when I bought it at 20 and 24 here, 25 or something, 24, 25. Yeah, somewhere here. So down here and up here. Sold some here. Yeah, I think I'll buy back if it's strong enough. I don't know. So MSTX, yeah, 2x leverage of MSTR. SMCI, let's see how that one's doing. It's still in that range. And the bad thing is today with the semiconductors going down, it did this. Not good. Not good. This is a terrible breakdown. It's below those moving averages now. Like if you bought here on March 4th or you bought here March 10th, 7th, or the opening day of like Tuesday on March 11th here, these are great. Like you got some good positions here and you probably sold when it moved up to over 42, right? Now the problem is it keeps fighting. It keeps fighting. And if we looked at the hourly, you can see it's not doing well since here March 12th. Like you got this move up in the first hour, right? And it goes down. So it's up here, goes down, moves up into close, but ends still near that resistance. And then the next day it just goes down. Now, on Friday, it opens here, right? At the 39. It moves up the range to 42. Now, what's the problem here? Today, we open just below the resistance of 42. We go up. Okay. And then we go back down. And then the rest of the day, we go down. That was yesterday. And then today, we just go straight down right through here. Bad. Terrible. So if I looked at these hourly candles like this is no. Sorry. This is not good. Now, it could just tap 34 again, right? Tomorrow, and then bounce up into Friday, 42. But then are you going to say, hey, what's going to happen next week? Are we going to finally break out? I don't know. I don't like this. I don't like the way it's looking right now. Okay, that's very tough. Very tough for me to say. So let's look at the QQQ. Okay, so moving down here. All right. So we tapped this range yesterday at 493 on the QQQ NASDAQ. And went down the first hour, and guess what? Didn't recover in lunchtime, so I was like, whatever. Let's see how low it goes. So now we're here. We're here below this 486 area. All right. So if you still want to have a chance, you better take 493 by Friday, because you got a whole lot of trouble at 497, 98 to 503. This ain't even the real wall. This is the wall. This is the wall. This is the challenge. We're not even there yet. Now let's look at SPY. SPY here at 568. Okay, so we went back below. So we're fighting in the wall for SPY. We're fighting in the wall between 570 and 575. Okay, so now I'm gonna play a video. All right, I'm going to play the video here where this guy goes over everything. So remember these levels. And you can see what this person says. I have one updated video, but I'm going to play the one from 2 days ago.
Gentlemen, buckle up. Today's video is going to be important, and it's going to get right to the point. We've been looking for a face melter of a rally that the freight train would hit. Remember? Well, it came and it hit. It hit pretty hard. We're going to map out some levels to watch if the market wants to continue to press on this, because in 2022, there's something a very similar type analog. And from a psychological standpoint, you really need to understand how that played out. So we're going to walk through that today. We're going to get into the market conditions and obviously the expected moves for you more tactical traders on today's Stock Market Brief Show, which is brought to you with my partners, Interactive Brokers. So make sure to check out their campus. They offer a lot of tools, resources, free courses for technical analysis, for options trading, etc., for futures trading, you name it. And obviously my patrons, for $9 a month, they get all types of benefits. By the way, if you sign up for the Patreon, you need to sync the Discord up to the Patreon account in order to get access to all the benefits. I plan on making a video that goes through all these things because there is a lot on there for the $9 a month, or you can save annually by signing up for the annual thing. Let's get into today's show. All right, welcome back, people. We're going to get right into it today. 11 sectors that make up the S&P 500. We had consumer discretionary, tech leading the way. Very risk-on type day. You saw the move in Tesla. Don't need to beat the dead horse, so to speak, here on that. S&P 500, all these products up. VIX was down. If you remember the weekly chart, how when we get extended from the weekly 5 EMA, you're likely to see a snapback, right? We've been using the analogy of a rubber band, right? Things get stretched, they typically snap back, right? And if things get really crazy, right, this rubber band might snap, but we always come back to tag it. We got very extended, boom, there you go. There's the snapback into it. We've seen this countless times. Where can the rally go to? What are some key levels? I think it's important to pay attention to the analog of 2022, just so you understand the psychology behind a rapid rally, and if it were to reverse and continue to the downside. Now, obviously, there's going to be people that say, well, 2022, oil was doing XYZ and we had the war and this and that, and this time is different. I already know that. So just, if you want to leave a comment, think of something a little bit more creative. We had the false breakout over here in 2021 going into 2022. Okay. This is what's so interesting. Bam, we broke out to new all-time highs. People get excited. Bull trap. We sunk off 12.5%. 10%. Okay, but what's more important here is that we're getting below the 200-day moving average, or the 40-week, the 30-week moving average, and a declining 10-week moving average, which is roughly the 50-day moving average. And we saw a massive snapback. Now, where did that snapback come to? It got back above the 40-week moving average, the 20-day or the 200-day, got back to the 30-week moving average, and got back above the 50-day moving average as well. Overall, what was that? It was a 50 to 61.8% retracement of this massive sell-off. So we saw a massive rally back that ended up getting faded quite later. Now, why is this interesting to me? Well, because we just hit new all-time highs right here, broke out, right? We're probably one of the only channels that we're talking about the possibilities and the probabilities of a bull trap, meaning that we'd break out and we'd fade. So if you want to go watch those videos, go on my YouTube, go back to when it happened and watch those videos leading up to it. And then we sunk off very quick and aggressively as well, 10%. Right? Over 10%, 10.5%, 11%, whatever. Okay. Now we started to a bounce back. So what can be a level above us if we're going to see this same type of analogy, same type of psychology, where obviously what I'm talking about is we're super greedy up here. People don't realize that we can have a bull trap. Then when we get down here, all of a sudden everyone's bearish and the market's going to break down to 1929 and blah, 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 blah. And then all of a sudden we get a snapback rally, and those same exact people then are trying to think about, oh no, my FOMO, now I got to get in. And they typically get in when the market starts to turn back over. Okay. That's the data that we have right now. So if I were to map out the golden zone, right, the 50 to 61.8% retracement from this high to this current low, that would bring the S&P 500 to and around this 590, which is an interesting area, especially if you map this out on ES. Right? Do you remember that range that we traded in, that we talked about over and over again while we were chopping around in this just volatility zone in here? Well, when we finally broke out, we saw the squeeze bigger to the downside. And you can see if we were to come back into this 50 to 61.8% retracement level, that would be touching the underbelly of really this big box that we kind of had traded in for multiple months. So I think that this is going to be an important level to watch. If it's a strong move, you don't want to just chase into it. You got to wait for consolidations and wait for the pristine times that offer good risk to reward to make sure that you're not just hopping in and FOMOing in, that you're prepared for turns. Like we've been preparing for a turn in the market, just like we prepared for a turn over here. And hopefully you managed to protect some of your capital on the way down and maybe caught a little bit of this move. And now we look for more strength to see if we can get to new all-time highs and produce higher. We don't know. And if you think that you do, well, you don't. That's just the reality of it. A couple interesting levels here. While we're rallying, this is a 65-minute chart of the SPY. Right over here is the all-time high anchor VWAP. Right over here was the handoff to the month to date. In the month to date, you can see we've tagged it, we've tagged it, we've tagged it. It acted as resistance. It started flattening out. Today, we got it back above it. And where do we come into? We came into the all-time high anchored volume weighted average price on a strong move. So if we get follow through, I'd still be watching for consolidations from this level to see if we can press up higher. If we consolidate ahead of time and we come back to the month to date, I would be looking for strength from the month to date VWAP, or maybe it undercuts it and then turns around. I call that a U-turn, right? Where price comes in underneath a key level, then turns back around, and then you could basically buy here. It'd be the same time as buying the dip over here, but you're just waiting out this, right? So you always want to wait to see what that strength looks like if we were to pull in. And if that's the case, maybe we go for another round 2 or round 4 or 5, I guess, because this was round 1, this was round 2, this was round 3. That would be round 4, whenever that, if that were to happen. That would be an interesting point level to look into. And if we get a strong move from that, maybe we come back and test the belly of that again to potentially head higher as well. Now, you may have heard the term island reversal. That's what happened in the Qs. We gapped down from this high over here. We had a lot of trade that took place right over here. We had our follow through day, right? Those were the days that we were talking about getting a little bit more exposure in on the Qs or the IWM, right? SPY technically didn't have its follow through day, but in all reality, if it's above 1%, I guess you can count it. So we kind of gave that some wiggle room there. But the Qs did, and the IW did. And this right here is an island reversal pattern, which marks potential turning points in the market. So if we were going to continue to the upside, where can we potentially go to? Well, take a look. Well, this was prior resistance. And once resistance was broken, it became support, right? And once support is broken, well, it could potentially become resistance again. And if you're looking at this in the context of this sell-off, well, where is this red zone, right? It was prior support, then it was prior support over here. Okay, this is actually about the 50% retracement level to 61% retracement level of this rally. So if we come into here on a strong move, a lot of FOMO is going to take place, but we don't know how price is going to respond in and around these levels, if it's going to reject and it's going to put in a lower high, or if we're going to consolidate, pull in, or maybe not even reach there, and then eventually start to break and break through these levels. So it's going to require patience. It's going to require the ability to really not hold high convictions. And if you're very confident about your convictions of what the market's going to do and you're wrong, you just got to have those kind of loosely held to be able to adapt with what the market can potentially do. Now let's take a look at the current market conditions, right? We look at the gamma flip line. The gamma flip line roughly is just above 5,800, 5,820 and some change. So we're still in negative gamma. This is where you can get buying into buying, selling into selling. This is where the crazy kind of rallies and the crazy sell-offs take place. So we're still under it. So that's check one. It's still a good trading environment as we're under that. But then we're above the 5-day moving average in the SPY, the Q, IWM, and so forth. And these are those are positive things. This is where you want to give more benefit to the bulls in the shorter time frame, because this is shorter time frames here. This is a more positive change in the market. We tied this with some oversold conditions. We tied this with the higher low in the semiconductors while these products were going lower. These are all kind of signs. And then we said various sentiment charts and so forth to kind of prepare us, saying, hey, if you're short here, you might be looking to cover. And we got a pretty nice move overall. Another element we've been watching was the VIX curve, the VIX futures curve. And right now, what's it saying? Well, we're in contango. We were in backwardation, and clearly the market was having its little tissy fit while we were there. It basically just states that, hey, there was more fear right now at this current contract than there was looking out into the future. Now it says, hey, yeah, we look to more fear in the future, like always. That's typically thing. We also talked about back month versus front month volatility, how it was getting under this 1.0 level and kept on diving. But we said anything under here, this is where you start to look for the market to rally and potentially, for it to market to potentially base out, to potentially bounce a little bit, because it rotates from extremes. And we're starting to see the rally, and this is starting to
Oh, yo, sorry about that. Looks like, yeah, StreamYard is killing my laptop, man. Holy shit. All right, hold on. Let me get back to this.
Ladies and gentlemen, buckle up. Today's video is going to be important. Back month is 20. And these are those are positive things. This is where you want to give more benefit to the bulls in the shorter time frame, because this is shorter time frames here. This is a more positive change in the market. We tied this with some oversold conditions. We tied this with the higher low in the semiconductors while these products were going lower. These are all kind of signs. And then we said various sentiment charts and so forth to kind of prepare us saying, hey, if you're short here, you might be looking to cover. And we got a pretty nice move overall. Another element we've been watching was the VIX curve, the VIX futures curve. And right now, what's it saying? Well, we're in contango. We were in backwardation, and clearly the market was having its little tissy fit while we were there. It basically just states that, hey, there was more fear right now at this current contract than there was looking out into the future. Now it says, hey, yeah, we look to more fear in the future, like always. That's typically thing. We also talked about back month versus front month volatility, how it was getting under this 1.0 level and kept on diving. But we said anything under here, this is where you start to look for the market to rally and potentially, for it to market to potentially base out, to potentially bounce a little bit, because it rotates from extremes. And we're starting to see the rally, and this is starting to head higher. So what happens if we get to 1.20? This is 20%, which that means, right? Back month is 20% higher. And over the course of other times, we've noticed that, hey, when it gets up into these levels, it can be kind of an overbought rally and things might need to just calm down or consolidate. For those that want to take a look at the gamma levels, the zero date levels, the ones that I keep an eye on, once again, take a look at gammalab.io, use code MSD50 to give you 50% off the first month. Pretty cool product. And you can build out a dashboard and you have all your news feed over here. Pretty cool stuff and ridiculous price. I don't think that there's any service on the internet that offers this type of stuff for that price. I think there's a lot of great services out there, but for $15 a month, you can simply just not beat that. Okay, and by the way, that's the one that I use for my Gamma Flip line if you always wanted to look at it and so forth, or zero date levels if you're a more active trader and so forth, or you can just watch this show and I try to update you as much as I can. Let's look at some expected moves. We'll start here with the S&P 500. So as we already previously noted, it did come into the all-time high anchored VWAP. And guess what? Today, day one, Monday, which if you remember on the last brief at the very end, what did we say? We said that typically the outsized moves have been happening on Mondays. So we came into the upper weekly implied move. This to me, it means that the market reached its happy spot. So if we start breaking above higher and we come into the daily zone tomorrow, right? The daily expected move for tomorrow, which is roughly 578 to about 580 up in this area. I would think that up in this area will probably likely see a pullback into the weekly expected move, right? It's not a guarantee, but I think that that would be a high likelihood because from history, what it suggests is once we tag these weekly implied moves, just like we tagged the lower ones, we broke down underneath it and we came back in and we doodled around. So to doodle around here makes sense. So a couple ways to approach this. If we don't break out tomorrow of this expected weekly range and we come in, well, guess what? Start looking at the lower daily implied move, the 5.
So that's what happened today. We went down. Okay. So let me present this article for you. So these expected moves are kind of like the quantitative analysis stuff I talked about the last presentation. So I'm going to show you this here, the trend spider, and I'm going to give you the link. Okay, in the chat. Okay, so you can look at it yourself. So if you buy this package with the spot gamma and then put it into trend spider, I don't use it myself, okay, but I know where these guys get this stuff. And yeah, you can pay for it. They'll give you a lot of details, you know, just like that. All those Vanna flows and charm flows that were given in the last presentation where I played that long Samantha LeDuc 1 hour presentation. So here they'll give you like call wall, put wall, volatility trigger, gamma strike, implied 1 day move. So this is the stuff that he's using here, implied 1 day move. So with that, what happens is, you know, let me see, zoom in here, put wall, okay. Blah, 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 blah. Let's see. 1 day move. Did they put that in here? I guess it doesn't look exactly the same as that, huh? Yeah, I mean, I guess they just put the lines here, but I think this is where he gets it, where he gets those boxes. So 1 day estimated move. When the price breaks above or below the 1 day estimated range levels, the market considers it to be overbought or oversold. In fact, according to Spot Gamma's data, the market closes the day within the boundaries of the 1 day estimated range 78% of the time, thus making these levels low risk areas to attempt a mean reversion trade. Okay, and let's see, derived from current options pricing. Okay, so these things come from the options market. All right, that's about it. That's all I gotta know. Hey, roller skater Texas girl. So let's continue with the video.
In confluence with the month to date, start to look for strength after that to potentially play it back up to there or even higher. And if it comes into this, I don't know if you necessarily want to short it or not, but if market net flow suggests it, or if you see how it's shaping up through the day, maybe then you can play back into here. But remember, the risk to reward is not great, right? If you're just playing back into here. But for the more active traders that know how to manage risk, that could be an option. The next level to watch for is last year's closing price, right? Once the price has memory. So watch the last year's closing price and watch how price kind of doodles around there. If we can get up there, maybe not by tomorrow, but maybe we're going to come back for that at some point here in the near future. That's about 586. Let's take a look over here at Qs, right? We're above that rising 5-day. We're well above the month-to-date VWAP right there. And we did not tag the upper weekly implied move. So my thought is, if the Qs, if the big NASDAQ stocks can all of a sudden gain some more momentum, right? That means we can come into the weekly implied move. That is the move that's going to help drive us through and up to the daily implied move over here in SPY. Because remember, they're the same names to the extent, right? SPY is a cap-weighted index. They have the MAG 7 stocks in there, and Qs haven't reached it yet, but they're close. So if the Qs, right, if they want to, if all of them want to start playing ball here, because if you look at this, Microsoft didn't really play ball all too much. It was Tesla that was playing big time ball, right? Meta did good, Amazon did good, Google did okay, Apple was all right. But if we're going to get the Qs to the upper implied move for the week, I think that that's going to drive the S&P 500 to there, and that's where we can look into confluences and potentially see price stall out in the meantime, and then we could kind of see how it digests, see how it consolidates, right? Say if it does come up there and doodles around here for the remainder of a week, right? That's quite a bit of time to digest. The 5-day moving average is going to turn up, right? The month to date is going to turn up, and maybe that sets up for another rally up higher to these higher levels that we kind of mapped out over here. For example, the Qs 500 to 510 is still some really good upside, right? It's not even on my screen, but that's still some really good upside. So I'd like to see how that consolidates and sets up, because you want to be a part of that if that's the case. And if it's going to break out higher, right? We don't know if it's going to stall out at those levels up here. We don't know if it's going to stall out or what it's going to do, but if we were able to play it up into there, that's great opportunity. And if it consolidates and if it doesn't get rejected fully and we turn it back around, these are all great opportunities to have some exposure into the market, but to doesn't get opportunity. And if it consolidates and if it doesn't get rejected fully and we turn it back around, these are all great opportunities to have some exposure into the market, but to manage risk of the market, but to manage risk effectively as you see fit. That's all.
Okay, I'm gonna play the next video. Okay, I'll play the next video. And this is today's video from the same guy. All right, so this is updated.
Announced 25% tariffs on all cars not made in the United States. Financial Times reported NVIDIA's China sales face threat from Beijing's environmental curbs. We had durable good orders come in, which raised some questions on how tariffs might affect the future demand. We have Fed members Kashkari and Goulby both coming out and talking about we could see lower rates into the future, but there are some uncertainties. We should kind of keep them where they are at for longer. And you can see that we have about 2 rate cuts priced in now for the remainder of the year. In today's Stock Market Brief show, we are going to dive into what matters most. We're going to look into the market conditions. We're going to talk about expected moves and ultimately answer what's today's price.
So I'm going to skip ahead. All right. Let's see. About, 5 minutes. Okay.
If it was more gray down here, or if SPY was flattening out, it'd tell a different story. Or if the green line was above the red line, it would tell you a different story. But this entirety of the trading session basically said, don't bother buying the dip intraday, right? So we'll see. Maybe tomorrow changes it. Maybe the next day changes. If you're in the Discord, you can bring up this chart. It doesn't have convergence down here, but it'll show you the red and the green line. and the price of the SPY. And that's part of one of the things in the query channel that's offered by TradyTix bot that I have in the Discord. If you look at some of the weekly expected moves, is NVIDIA doing anything outside of the normal that the market didn't prepare for? At this moment, no, it's actually still above its lower weekly expected move. How about Tesla? Yeah, Tesla's actually doing a lot better than expected. It blew through the weekly expected move. And what did it do today? It pulled right back into it. Big deal, right? Take a look at Google. Google, what did it do? It broke outside of the expected move. It's coming back in to where? To where the market priced in its risk for the week, getting back below that 5-day moving average, which is kind of flattening out right there. And then Meta, what did Meta do? Meta got outside of its weekly implied move. Guess what? When things get heated, sometimes they come right back in. This is very common thing. This is common to see happen when you start to reach into these weekly implied moves. Let's take a look at the current market conditions. So I wanted to just point out that the S&P 500, right? This is the 2-hour chart. Where was this anchored from? This volume weighted average price, right? It was anchored from the all-time high. Where did price come into? It came into it, and then it started backing off. This was one of the scenarios that we painted on the prior video. And where are we coming down to? What's this blue line? The blue line is the month-to-date start volume weighted average price. So we broke above it. We found some resistance. And now we're pulling back in, and we're holding above it at this current moment, which is causing price to contract between these two VWAPs. So right now we're kind of in the chop, and that's kind of really around this 5,700 to 5,800. So I'd say, yeah, I'd be fine to be bullish above 5,700. If it starts breaking below, I'd be more cautious. And if we start getting back up to 5,800, I'd be a little bit more cautious for some consolidation. That's where the gamma flip line is, and that's where another interesting level from a gamma perspective is. CTAs, right? If we look at CTA positioning, these are commodity trading advisors. They trade with momentum via, they're basically algorithms, right? So this is going on. There have been net sellers, right? As we've been seeing more volatility, as the market's been going off, they're big sellers and they are not buyers right now. As you can still see, they're just massively on the short side of this. If you look at vol control funds, this is another one. The exposure has been dropping here from basically, it's been dropping into March, right? From late February. And this is just telling us that volatility has been rising and promoting volatility control strategies to really just de-risk and sell into these equities. So in short, vol control positioning has been net sellers over here, and CTAs have been net sellers here, which is helping drive the volatility that we have been seeing in the overall markets. If you like these type of charts, let me fix that. If you like these type of charts and you want to see updates on them more so frequently than I do post on here, take a look at gammalab.io. It's only $15 a month, but you get your first month half off if you use code MSD50. It's a great service. I use it all the time. I export my gamma levels onto my TradingView charts using this. They have a news feed. You can build out a dashboard. It's cool stuff. Now, the next thing of market conditions I look at is the direction of the 5-day moving average. We have yellow now, which is just telling us price is below it, but it's still calculating up. We have Qs in yellow, and we started seeing semiconductors get hit. XBI, it's just been choppy. That's back to red. And IWM's turning red too, as it's starting to flatten out over here too as well. And then DIA is holding. So a lot of chop over here overall. We'll get a little bit more tactical on the expected move section. If we take a look at the follow through days, we'll follow up on the follow through days here, looking at the S&P 500. So the low, it's still active, right? This low has not been breached. We had day 1, 2, 3. Day 4, we gave it kind of some leeway and we'll count it as a follow through day, even though that it wasn't the technical 1.25%. It was above 1%, which according to them, they still may count that with higher volume than the prior trading day. Now we just had day 9, and this would be technically considered a distribution day. You really don't want to see these follow through days, right? Cut. So even if we come down and doodle around, I mean, it's still holding up rather well. And you can see as price had a very strong move, where did we come into? We just came into the weekly implied move, right, for the S&P 500, which was in confluence with the all-time high VWAP. So this to me is actually kind of what I want to see. I want to see price pull back in, reset back up, flush some people out, come back in, put another high in or something, or lower high, higher low in, and then start to potentially then look to break out. But right now, what's it look like, right? A lot of people are going to just look at this and like, it's a bear flag, and they may be right, but we still have, I mean, a lot of time left to really just prove itself. And we're pretty far off of this low to continue to try and prove itself. Let's look at these expected moves. All right, this is the SPY. This is the looking from a pretty much a year-to-date perspective over here for 2025. And you'll see these orange lines on my screen. This is showing that each week's expected move. And what do you notice? You saw it go from 7 to 11 to 12 to 15. Okay, it was expanding, and now all of a sudden it went from 15 to 14 to 10. So now once again we're contracting, which kind of goes hand in hand with what we just said about this chart, how price action is pinching between these two VWAPs. Price is contracting after an expansion. So even the volatility here is too as well, and it's still trading well within its expected move, and we're still actually holding up from a week to date perspective. So even if we come back over here, I mean, we would be flat to slightly down on the week if we were to just come right back into obviously last week's close. And then we're right there at the month to date expected move. So we've been trading there. It's kind of been this kind of gravity point, this magnetic point here as price has been doodling around. And these levels we've got at the end of February for the beginning of March, and we've just been kind of doodling there. Okay, so let's take a look at the SPY on the 15-minute time frame. One of the scenarios that we did plan out was that, hey, we can have prices doodle around, and what I would like to see is price to come in a bit. And price came in a bit, and what we were looking for is a potential U-turn of some sort here with the month-to-date VWAP. And I wouldn't really consider this a U-turn, but maybe tomorrow, right, if we can come back in a little bit more, doodle around, and then start seeing strength back up and reclaiming this 5-day moving average, I would consider that more of a U-turn. Overall, though, if we start breaking down, I want to see this swing low volume weighted average price to continue to hold. So if we break down and come into the daily implied move, I'm not really all that interested until we start coming back and turning around. And if we don't get down there, right, I'm looking to still kind of get back above just around this area, maybe anchor on the daily VWAP. Maybe we pull up into the week to date. Okay, and that's declining. Then we get a little bit rejected, shake some people out, and then potentially start to turn up back into and around these areas. Now, if we all of a sudden just rip right up here based off of whatever, just keep in mind the levels of confluence here. Now we have the all-time high VWAP, which is the white line. Then we have the daily expected move in line with the weekly implied move. So really right now, I would just say, just be very cautious. Don't get chopped up in this environment. It's not offering up like super clear, it's going to go up, it's going to go down sort of scenarios. It's going to do both, right? Which if you don't realize that by now, that the market's going to go up and it's going to go down, well then, yeah, where have you been? Let's take a look at the Qs. Q's daily implied move can bring us down to an around 40.7730, 479.18, this zone in here. The upper level can take us to an around 490 to 491 and some change. Well, you can see that we're just pinning around that month to date VWAP, which we had resistance. Once resistance is broken, it has the potential to become support. I would say that we're on it right now. So now it has to prove itself and break from those areas and see that strength. Now, if that's the case and that happens, watch the week to date VWAP because that can act as a level of resistance. Notice how it acted as support. Then when we broke down, it really saw some strong sell side activity there. Okay, if we continue to break down into tomorrow, I mean, just play it as you see, right? Because if the market doesn't like this over the night news and we just gap down into these ranges, the market might all of a sudden say, hey, and then all of a sudden rip higher. And what happens if it rips higher based off of this tariff news? That's the market telling you like, hey, maybe perhaps now that we got our closure on what's happening, there was a lot of uncertainty. Now, all of a sudden, we're more certain about what's going to be going on. Maybe that's what drives the market higher, right? Now, that's just a narrative, but price will tell you what the market wants or what the market is doing, right? Obviously, because price is not going to lie to you. If market's going higher, it's telling us that, hey, things are getting better, right? And if the market keeps selling off, it's because, well, we see uncertainty and the market doesn't like. It's because, well, we see uncertainty and the market. It's because, well, we see uncertainty and the.
Hey, what's up? Yeah, man, StreamYard keeps cutting the end of these things. I don't know. I think you guys got the point. So we're still in the range, and we gotta watch how it does. Tomorrow we will have. Okay, let's see what we got here. See, Bitcoin's still doing okay. All right. But here we are. Let's look at the calendar. So tomorrow we'll have our final GDP number for Q4 last year. So this is stale data. I don't think any of this will matter unless there's some crazy revision in how they estimated last quarter's data. So this is 3-month-old data by now. So I don't know how this is going to affect anything, but who knows? Maybe something will happen. We'll definitely get our jobless claims report, usual things. Then 7 o'clock, you get pending home sales. I don't know if that will affect things too much. Kansas City, Kansas Fed stuff. No, I don't think that will affect anything. But Friday, we will have PCE. Okay, PCE will come in at 5:30 a.m. Pacific. So you'll see it 8:30 a.m. Eastern. All right. And again, tomorrow we'll have 5:30 a.m. Pacific, my time for GDP, and 8:30 a.m. tomorrow, GDP. But Friday, 8:30 will be the key one to look at. All right. All right. And let me play this. So I got 30 minutes. Let's see. I wonder how long this video is. Let's see if I can end this. I guess I didn't get a chance to play more of the copper stuff. I'll play that tomorrow maybe. Yeah, but and I had some other Samantha LaDuke short videos. I guess I'll have to play those tomorrow. I want to play this one about volatility, VIX. So I think this will be important. So let me refresh your memory with Martin Shkreli. Okay, talk about options. So I played this last time. I want you to remember what options are.
I don't like ever buying vol. Okay. Anybody who buys vol is kind of a sucker to begin with. So you should never want to be long vol, especially after a VIX spike, right? You know, the old saying is the premium writers make the money. So if you're long vol, I mean, you're really making an opinion, a strong opinion. And here's the thing. Okay? If you're short a stock or long a stock, let's go long because it's easier to understand. If you're long a stock and it does this, isn't this the best possible thing, right? This is the best possible chart according to many investors. Some investors think the best possible chart is this. Some disagree. There's a big, debate out there in the high-end investor, high finance community. The problem with this is the vol, which is unlikely to repeat itself. You're not going to keep going up in this direction, right? This is much more realistic. Because when you have this, you're probably going to have, something that looks like this. Then you have something looks like this. Options are great in this regime, right? Options are terrible to own in this regime. So you might be bullish on a stock and buy calls and you get this guy. And you are upset because your calls didn't really appreciate in value because you played a high implied volatility, high IV. And if you're not looking at the historical IV and stuff like that, which again, I'm going to teach you guys with Godel at some point. I'm going to teach you guys all about options. Then, we got an options expert. We might be bringing on senior Wall Street guy, smart Wall Street guy, put it that way. Regardless, an options expert. So, you got to be pretty smart about how you play options. I'm not just, when I say smart.
Okay, so you got that, right? Volatility. That's important in options. Okay, now let me play this video. We're just going to talk options now. So I ran across this one like a couple weeks ago. I think this is a good time to play it since today VIX is climbing back up. So looking at that VIX level, VIX, volatility index, is going to be important, right? So if we are really going to have a crazy April, it's going to be a lot crazier than the last several weeks, I think. So let's see what happens. All right. I think this will be important.
Hello there, and welcome to our latest episode of the Market Misbehavior.
Okay, I'm going to skip ahead.
From the, and I've done a bunch of stuff.
Okay.
Exist anymore, but
okay.
If you need to do that, S&P 100.
Really good charts about volatility, which I think is so important because the VIX is now I'll use a break of.
Okay, where's the intro?
Before we got started, I feel like super excited to be sitting down today with Jay Soloff. Jay's the lead options analyst at Investors Alley. Jay, it's been a pleasure to interview you a number of times over the years, but especially now, I feel like plenty to talk about. So before we get started, how are things on your side? You doing all right these days?
Yeah, thanks, David. It's always, it's always great to be here. I know feels like it's been 3-4 years now, that maybe more, that we've been doing this. So
yeah.
It's time flies. But yeah, it's definitely been exciting. Certainly the markets are keeping us on our toes lately.
I feel when we were talking before we got started, I feel like there's plenty going on here. I think we could all use a break of some sort, but I don't know if we'll see how that plays out over the next 20 minutes or so. But I don't know if a break is in the cards for either of us here in the short term. But we'll see. So Jay, before we get to the charts, and you brought some really good charts about volatility, which I think is so important because the VIX is now really changed from where it was last year to now 2025. So I really want to dig into that. But before we do that, give us a little bit of the Jay Soloff origin story. I think you started as a market maker, right? I want to say like CBOE or CBO, right?
Yeah, that's exactly. Yeah, exactly.
Talk to us about those sort of formative years. When was that? What sort of, what were those early experiences that shaped, I guess, the trader, the analyst that you are today?
Yeah, absolutely. So I'm from Kansas City. So I actually started at the Kansas City Board of Trade when they had a floor. Basically, they only traded wheat. Well, they traded a couple things. Value Line, which was actually the first stock index, but it got eclipsed pretty quickly by the S&P at that time. And but they traded a couple things. Value Line, which was actually the first stock index, but it got eclipsed pretty quickly by the S&P 500 or S&P 100, whatever was around at that time. And but it was big for wheat, and I worked for the exchange, so really it was just kind of like reporting prices but that got me interested in the derivative side of things. My background was economics, and I was just interested in all that stuff. But everyone on the floor there said, if you want to trade, you should trade options. That's where all the action is going to be. And if you need to do that, you should go to Chicago. And I had gone to University of Illinois, so I already had, I had a lot of contacts up there already. So, just to speed it up, I ended up, becoming a market maker on the options exchange on the CBOE there, after clerking in the S&P 500 pit. So kind of learning really about, just equity trading, equity option trading. I went into single stocks like Amazon, and WorldCom was a big one at the time. Of course, doesn't exist anymore.
Wow.
But what I really learned, which is interesting. Actually, a lot of the stuff in my pit that I worked in doesn't exist. It was either got gobbled up by another. A lot of them merged. Like Gillette was its own company, and I think it's like Procter stuff like that. But WorldCom was obviously a little bit more colorful experience. But what I really learned down there was that what professional traders look at is volatility. So that's what really shaped everything I've done from that, and I've done a bunch of stuff since then. I've gotten I went to get an MBA, and I tried my hand at more corporate finance and hedge fund type stuff. But I really options was what I would always come back to because I just really enjoy it. And, now mostly I'm more on the teaching side of things, and just newsletters, webinars, teaching, but I try to really focus on the volatility aspect, because that is what I think separates like the next level of option traders from people who are just like, oh, it's a leveraged way to trade directionally, right? Like that's how I think most people get into it. And you realize after a while that your edge is on the volatility side. So that tends to be my focus.
It's so interesting because I know in my I guess maybe ignorant early days of learning about the financial markets, this is like early 2000s for me. And I remember meeting with options traders, and I was laughing that they basically were looking at a big table of numbers essentially and thinking about volatilities, looking at all the Greeks. And I'm more of a visual guy, so I'm thinking charts, and it's all about picking the levels. And they would do that, but it was really more about volatility. I mean, at the end of the day, they were just looking at different ways of thinking about shifts in volatility. So you made a really good point, which is I feel like a lot of people early on, they think of options as a kind of leveraged way to make a directional bet, right? So I can, or a lower cost way to do it. But can you talk a little bit more about why volatility is so important, right? Why, as an options trader, is volatility so essential for identifying opportunities in the options market?
Yeah, absolutely. And I think this is, very, very much a misunderstood point, right? That, and I'm not saying, options, if you're an excellent directional trader and you can utilize options to increase your profit, great. Like I'm not good at that, right? Directional trading is really hard for me. But like my general thought is that if you're really good at picking direction, trade a stock, trade a futures, right? Why give yourself a time limit, which options obviously you can do 2-year out options and then it's similar to more of a stock or a future or whatever. But I mean, if you're doing short-term options and you're giving yourself that time limit, why do that? If you're a good directional trader, there's other ways you can do that. Why put yourself at a disadvantage where the clock is ticking on the option and it's slowly losing value? Put yourself at a disadvantage where the clock is ticking on the option and it's slowly losing value over time. To me, like, you want to try to take advantage of the inherent definition of an option, which is a short-term contract, and that is, the pricing is so much related to volatility. So your edge, really, your long-term edge, is understanding if an option is cheap or expensive. And again, like, I'm sure there's plenty of people who can use options directionally and do really well. I'm not one of them. So I've never really tried to say, oh, hey, I mean, maybe in my retirement account, I'll buy a long-term option.
Sure.
Just to keep my capital, like my Roth IRA, I have a limited amount of capital. So, okay, I have a directional opinion. I might buy a long-term option. I know what edge I'm giving up. It's just, it's one of those situations. But for the most part, if you ever look at a hedge fund that trades options, their focus is going to be on volatility, relative volatility, some kind of thing, that they're not doing directional trades, maybe a small portion of some portfolio, but they're doing other stuff, maybe to accentuate a stock return or something like that. So
right. And one of the things I've learned from, and again, I don't trade options a lot myself, but I've worked with a number of people and talked with people like you it's so helpful to just understand this different market and how it's structured and what the challenges and benefits are. But I know, like, certainly there are a lot of things, like stocks like Intel right now are just kind of dead sideways. They're kind of these choppy sideways markets. And if all you're doing is kind of plain vanilla long short stocks, you kind of just have to wait. You just have to wait for an opportunity. But with options, you have ways to bet on pretty much anything, right? A sideways market could be super profitable if you have the right structure on and you kind of go about it. So no, well said. I appreciate you talking through that. Let's get through some of the charts here, Jay, because you sent some charts of the VIX, and volatility has certainly changed, right? I mean, I think when you kind of like late 23 to 24, the VIX kind of in the low mid-teens a lot of the time. All of a sudden, in the last like 6 to 8 months, we saw the huge spike in the VIX, kind of last summer, July, August. And then we've kind of remained in this elevated sort of volatility phase. So here's a chart of the VIX that you shared. Talk us through the conditions of the VIX. What does this tell us here?
Yeah, so the VIX also, VIX is, it's been nice to see for me, like the VIX was this thing that we talked about on the floor in the late 90s that even traders on the floor, even not all the traders on the floor were necessarily talking about it then, right? It was just starting to get traction. Now it's like, you might see it in the same page that you see what the Dow is doing, what the NASDAQ is doing. You see what the VIX is doing. It's become really popular.
This is front page news now, Jay. This is above the fold.
But I don't think necessarily a lot of people, which I'm really happy about because I think it's super useful, but I don't know necessarily if a lot of people really understand. Just they understand that going higher means more volatility. And, obviously it's been labeled the fear index, so showing more fear. And I think that's actually a pretty good way to describe it. I think that, a lot of people don't realize. So one way to interpret it is that for every 16 whatever dollars levels, whatever, like this, the number 16 is important. That basically equates to the market expecting 1% moves per day. In this case, in the S&P 500. So when we're at 16, we would expect around a 1% move today, which actually, per day, which is actually, more than what's normal during regular times, right? We saw for a while there, we were seeing like close to 2% move. So you would expect the VIX to be over 30 in that. And we really just barely touched that. So it doesn't, you're going to have that environment for a while if you want to see the VIX stay up above 30. So, I mean, that's one good way of looking at it, but really it's based on option pricing. So when people buy more options, particularly on the put side, when it comes to indexes, it's a demand, it's a supply demand thing, right? You buy more options, the price goes up. That means volatility, implied volatility is going up, and that's what this measures. And so generally when you're seeing option buying in an index, it's hedging. People are buying puts. You see a lot more put buying than call buying normally in an index, right? Over time. And people buy puts to hedge because they're worried about the downside. So as people buy more puts, the price of puts go up, implied volatility goes up. That goes into this VIX calculation, and you see VIX go up. So that is, a pretty good sign that people are scared. Like, hedging is expensive. People aren't going to do it. Investors, portfolio managers, whoever is buying these, they're not going to do it unless they're worried, because puts are particularly when people are worried, puts are expensive, right? So I think it's a really good, and it generally starts to happen before any event happens. People start worrying about the next Fed meeting. You start seeing VIX go up because people are buying puts, right? If they're not worried about the Fed meeting, the level won't change. So it's a pretty good early warning indicator. And also maybe a regime indicator, right? When you're above, let's say 20 is kind of the long-term average, although 15, 16 is more the long-term median, because obviously like you see in August, you have these really high results that can skew that. But if you look at the long-term average, 20 is a pretty good level where people are saying, okay, I'm worried that, something could happen and the market's going to tank 5% in a day or something like that. So that's really kind of also a nice regime indicator saying, maybe I need to start being more conservative with my investments, or put some in cash, or put some in bonds, or whatever people do to protect themselves.
Right. Interesting. Okay, so the VIX is showing us sort of this, level of fear, I guess, or level of implied volatility. Talk to us a little bit about the term structure in the VIX. And I would say this is something we've not talked a lot about on the show before. So I'm very curious. The term structure appears to have changed a bit here. Talk us through what this is, this is telling us about the current conditions here.
Yeah, absolutely. And, I didn't mention this. So the VIX had dropped. So I brought up the chart, and I talked about the VIX and nothing about the chart. But what it was showing is that we have dropped from the highest levels back down to under 20. Looks like, as when I got this chart, we were just back under 20 for the first time since a lot of this tariff stuff started. So that's one sign that maybe it's still high relative to historical levels, right? Average, but it has, settled in a bit, compared to obviously where we were. So, maybe the market's internalizing the tariff stuff a little bit. Hard to say. So then I said, okay, well, we can look at that a little bit further, because the VIX itself is just a calculation. It's technically speaking, it's a variance swap calculation, which is, a professional sort of contract that even I've never touched in my life, but it's a good way to calculate sort of volatility that's not related to anything else. So, but you can't trade it. So the one thing you can trade then is futures, or options on futures, or ETFs, but the ETFs are all based on the futures. So then that's where the term structure comes in. And if you've ever traded futures, then, people who trade futures are generally aware of the term structure, right? It shows every future out through whatever, a year, 6 months, whatever it might be. And basically in plain English, when you have your front month, in this case, it was March, much higher than everything else, that is the month that everyone's focusing on. And in the case of VIX, that means that's the month that everyone's scared, right? Like, people are really worried if our front month is close to 30 and the back month out there is close to whatever 24, then clearly people are more concerned about the present than the future. And so when you see an inverted curve like this, think, inverted treasury yield, everyone's got these things. Oh, the curve's inverted, right? And you need to worry. Well, that's very true with the VIX, in this state, which we call backwardation. It really means people are very worried. So this is from March 10th. So not that long. So 10 days ago, right? But this is when the market was really getting hammered pretty hard, particularly tech.
Got it. So to recap, this is looking at the VIX futures, right? So related to, derived from the VIX index. But this is now we have futures, which means we have a term structure. We can look at expirations going out, month over month. And so the high reading or the high level of the futures on the March contract, and this is a week and a half, 2 weeks ago, way elevated compared to further down. So that implies a lot of uncertainty or elevated anxiety about the current market conditions. Is that fair?
Yeah, absolutely. I think there's an interesting difference between risk and uncertainty that, again, is not something that most traders realize, and your risk can be measured, right? And that's what I was talking about. Okay, every 16 points in the VIX, you kind of expect a 1% move per day. That's measurable. Obviously, it's not. It's an estimate. It's a probability, but it's measurable. When you see a curve like this, what we're looking at here, that means people are uncertain, and uncertainty can't be measured, and that's when you have like the craziest stuff happen, right? Because no one knows how to react because it's not a situation they're familiar with, so you can't really measure your risk. So I think this is kind of showing that. And again, it was only 10 days ago, right?
Yeah. So speaking of which, so the world has fluctuated a bit here. So this is probably earlier this week, I'm guessing. Today we're recording this on March 20th.
Yeah.
So this is now March 20th. So change in the shape of the term structure. What does that mean?
So and it's a little somewhat hard to see because it's zoomed in, which is the only way I could show it. But this is actually a pretty flat curve from around 20 to it's not even 20 to 22. It's probably somewhere less than 2 points. If you were to zoom out, it would almost look like a flat line. But you could certainly see that the front month future is lower than the back month future. So while the overall level is still elevated, right? We're still around 20 again, which is kind of your middle of your regime switching between I'm worried about the market high volatility to okay, things are a bit more normal. So we're not quite in high normal zone. We're right about there, but the curve has flattened out. So I think there's definitely less concern than there was. Although overall, the market is still the market is ready for if the administration announces a bunch of new tariffs tomorrow. The market is ready to get back to being, concerned and selling off and whatever. Like that's kind of what I'm seeing here.
But
not
no
as
fear,
much.
the uncertainty will come right back. I feel
it'll come right back. But right now we're more of just in a risky market rather than an uncertain market. So it's definitely better. And again, I'm wondering if maybe investors are kind of getting used to the back and forth of tariffs because I think that's more than anything. That's what's driving the concern now, just because. They can be recessionary, they can be inflationary. we're not even really sure because it's been 100 years, 120 years since like the last time we've kind of had an environment like this in the US. So no one's really sure necessarily how things are going to react. So I think that's why we're seeing this bouncing between kind of risk and uncertainty now.
Yeah. No, that's super helpful, Jay. That's something that I'm sure a lot of listeners have probably heard of, but have never really understood. It's a really good way of illustrating. I appreciate you bringing a couple of these charts with you. I'd love to ask you this. One of the biggest changes structurally in the options market, arguably in history, but certainly in the last couple of years, is the introduction of the 0 days to expiration options, right? Which are now, from my understanding, the most liquid or the most heavily traded part of the options market. How does the introduction of 0 DTE options and certainly the proliferation of them, how does that impact? Does it impact things like the VIX, things like the term structure of the VIX futures, or is it sort of a separate thing? Because some have speculated that the VIX may be different now because now you have this big chunk of the options market doing a different thing. Has that changed your understanding or your use of any of these indicators, or not so much?
That's a great question. I've actually been asked this. I actually got asked this at the Money Show too. You know, it's an interesting question that I've been pondering a lot, and I think it's kind of both yes and no to some extent. You know, the VIX is based on 30-day implied volatility. So
right,
as long as you're getting the action in the 30-day options, whatever happens to be in the SPX, then that's going to really drive the calculation. So to some extent, no, right? But then on the other hand, right, there are, you know, people or more like, you know, firms that have, let's say, gone to hedging using 0 DTE. They found maybe more efficiency of, instead of putting on a trade every month, literally doing it every day and letting it expire, like maybe more bang for their buck, or whatever, you know, they've done the math, of course, and realized. So to that extent, like, that may mean that you're not getting as much data going into the VIX as there used to be. But overall, I don't really think it's changed. It's changed other things, right? It's changed, you know, definitely where retail traders are playing. They're definitely playing much more at the short end of the curve. You know, like now people consider short end of the curve. You know, like now people consider 30 days long, you know, like the long term, right?
The new leap, right? Are 30 days out.
which is funny, right? Yeah, I mean, so which used to be as the shortest term you could trade. Like weeklies have only really gotten popular in the last 10, 15 years, right? So, you know, so I think the impact is still developing, but I don't really feel it. It's not. It's more. I guess it's more. It's definitely impacting volatility on a very short-term level, right? But when we're looking at the VIX, I don't think we see that. I think there might be other measures that show that a bit more, like more, you know, obviously more specific to the different instruments. It's probably, well, you don't have we'll have to see. We don't have 0 DTE in single stocks yet, but I'm sure that'll happen at some point, and that might be
matter of
another
time.
way.
I feel like, right?
Right.
So one final question, Jay, this has been awesome. And I really appreciate you spending some time on volatility, which I think is a real area where people stand to learn a lot more. And it's become more and more important, I feel like, to understand the current market environment. So based on everything we talked about, based on this sort of change in volatility, based on the VIX sort of around 20 at the moment as we're recording this, you know, what does that leave you when you're looking at the S&P 500? You're looking at stocks with the major averages down 10% or so in the last week. Now we're getting a bounce during Fed week here. You know, sort of apply everything we've talked about to what you're seeing in the markets now. Do you generally see reasons to be optimistic? How do you approach, or how do you play a market like this using options? What would you say to that?
Yeah, and that's it's an excellent question that you know, it's kind of saying, all right, you know, what's your prognosis? And I don't really know, but I'll say that it's because you know, this administration is very volatility inducing, right? With again, particularly with the tariffs. But you know, I would say that things are certainly being. I think, you know, investors adapt relatively quickly, right? And I think that as much as you know, I would say, like, as someone who has a background in economics, like, I don't agree with tariffs. I don't think they make sense for anybody, but I also don't think they're probably as big as a deal as people are making them out to seem. You actually run the numbers on it, and it's much smaller than what it's like. You hear huge numbers like 25%, and then you look at it, all right, well, it might be a couple bucks here and a couple bucks there. Now, of course, that's a huge amount when you're doing it on an international scale of billions of dollars, but you know, it's probably being overblown a little bit. But I think, you know, maybe some of the federal employees losing jobs might end up actually being the issue that could maybe push us into more of a recessionary environment. So I'm a little bit worried about that, and that remains to be seen. So I'm kind of cautiously optimistic, since we've seen things come down a little bit, that I bullish kind of for the rest of the year overall, but with a hedge in place, right? So
I noted it was bullish. It was posed as a question almost, Jay, which I love. That is a cautious bull if I've ever heard one. That was well done, well performed right there.
Thanks. Thank you. But yeah, so I'm kind of like a hedged bull basically right now.
That's right. No, this was a lot of fun, Jay. I can't thank you enough. I mean, this is a real pleasure and being able to ask someone like you with the experience.
All right. Okay, guys. So I think the two important things you got to learn is the VIX term structure. I kind of sprinkled it in the last several streams. And this last presentation gave you it one last time. So now let's drill it into you guys' heads, okay, about the VIX. And then the other thing that was a good nugget was that he said when the VIX moves around the 16 level, so once the VIX hits 16 and then jumps another 16, another 16. So every 16 intervals of the VIX implies that the S&P 500 moves around 1% more. So if the VIX is 16, then you should expect the S&P to move up and down 1%. And then once the VIX goes up another 16, right? So let's say it goes up to 32, then it will be moving 2% up and down. Then if the VIX goes up again, right, to 48, then that means 3%, right? I mean, if we go back to the COVID days, it was at 60, right? You saw moves that went up and down on the S&P 500, 5%, 7%. And that's when like the stock market just shuts down. If the index moves that much, then yeah, they'll have a circuit breaker day and it'll just stop everyone from trading. So those are wild times back in March 2020. Yeah. So let's put up here something to look at. So let's look at the VIX expiration dates. These you should remember when, like, they matter when we get into some crazy VIX. So whenever the VIX starts moving up, like about above 16, let's go to 20, right? Then you'll start paying attention. So the last one was March 18th, okay, 2025. All right. So that was the time when the VIX term structure was moving up. All right. So that's what was put in the presentation. Okay. So what is the VIX term structure now? Well, the VIX term structure now is, down. My bad. So before the 18th, right? So we get from the 18th and before, it was moving down. Okay, going this way. All right. So let me draw it. Let me just draw it on the chart here. So let me show you the VIX on this chart. Let's go to here. Okay. So let's see, what was the 18th? 18th. Okay, right here. That Tuesday, right? So we're moving up into it. All right, that Tuesday. That's when we got stuck in this range. That's when we finally got stuck in this range. All right, 18th, right there. Okay, so let's look at the VIX. Okay, let's see. 18th, right here. That was the last big move there. All right, but the VIX was moving down anyway at that point. Okay. So when you look at the term structure, the VIX futures, what happened is like it's going this way. So that's how the term structure looks. So you have a higher priced spot price or near term contract and a cheaper long-term back contract date price. Okay, so they would call this the contango, I believe so, if I'm correct. Now, I'm not a futures guy, so let me double check that for you. I think that's called contango. All right, contango. Let's see. Price of future contract is trading at a premium to the it's contango. The price will rise over. Oh, that's not bad. That's not right. So let's see. So I'm wrong. So let's check that. Price contango. Yeah, I'm right. Okay, I'm right. All right. Man, I always get confused. Okay, so this is contango. All right. Okay. So when the futures price term structure goes like this, when it goes like that, that's backwardation. All right. That's backwardation. That's normal. All right. It should be more expensive in the future. So you guys can look that up. Funny little names, huh? Okay. And this is contango. All right. Okay. Now let's look at the term structure. So let me give you a website and you can look at it there because you're not going to get it from here. Okay. From the trading view chart here. All right. Go back there. All right. And let me take that away and put this up. Okay. So you can go here, VixCentral.com. All right. So this is what it looks like right now. So this was after the 18th. Okay. So now it looks normal now. So we have cheaper price, near term, 30-day. Okay. In 20 days, I guess, from here. And then more expensive in 237 days. All right. This is how it looks. So we have less volatility now, potentially more volatility later. That's how it should look. People are hedged for the future. All right, so that's VixCentral.com. This is how it should look like. But when we were in the high volatility regime, guess what? We were going up to down. We weren't going this way. We were going the reverse way. All right. Yeah, I should get some tool to draw on the screen or something. Now, let's look at, okay, we got the calendar and that's it. So I put it there. All right. So let's go back to the chart. Okay. Actually, you can look at historical prices here, all kinds of stuff, and you could see how they looked before. Yeah, 2008 was when VIX was at 63. Yeah, that was crazy times. Anyhow, let me see how it was in March. Let's see, March 10th, 2020. How about that? That was probably when everything was crazy. Yeah, it was at 40. Let's see later March of 2020. Let's see when it was 24th. How about that? Yeah, 48. Okay. So we did have at that point, yeah, pretty close to like 3-4% days. Yeah. So every 16, right? Every 16. So yeah, we were getting there. We were getting there. I swear we probably hit 60 at some point too during that time. Let's see. Yeah. Maybe it was towards the end. I don't know. Maybe it was the 20th. Maybe Fridays would have been worse. Let's see, Friday. Yes, that Friday, March 20th. That was the craziest time right there. So once we got to hit the 60 of VIX of 60, that's when we started seeing those 5% moves that week, towards the end of that week. Okay. So right now, VIX is at like 18 something. So we've gone from 17 back up to 18. So yeah, gotta pay attention. If it starts climbing towards 30 again, oh boy, yeah, we're not gonna be having a good time next week, I think. Okay, so gotta pay attention to that VIX. All right, so yeah, we got 2 hours. So yeah, please like and subscribe. I'll come back tomorrow if something crazy happens. Okay, but for now, if you have stuff from last week that you held and didn't sell Monday, Tuesday, yeah, you can keep holding it if you wish. I highly recommend that you try to sell by Friday. So if Friday you get a good PCE data and the market moves back up again, I wouldn't trust the weekend. Yeah, I wouldn't be trusting that weekend, I think. April Fools, right? Yeah, you're going to get April Fools on Tuesday. You have 31st on Monday, so the last trading day on that Monday. Let me see. I have some videos I gotta play up too. So yeah, I'll probably have to show up tomorrow, even if it's a boring day, because I'm gonna have to play up some more videos from Samantha. Yeah, I'm gonna play some videos from her and Probably that copper video. It might be some other videos I had in store here. But overall, what can I say? I gotta wait. I gotta wait for next week. I think we have to wait for next week. All right, roller skater, Texas girls. Good night. I'll see ya. Yeah, email at crack@jghb.info. That's my email. And you can donate to Porsche, $PORSHA. Right here, let me put it up on the screen for you. PORSHA, right? Yeah, JAYE. That's $, and PayPal. PORSHA@jghb.info. Or you can donate at Streamlabs, streamlabs.com/theurbanlandlord. Okay, very good. We still have 1.3 subscribers. I don't know if we're gonna get to 5K anytime soon, but we'll see. We'll see. But I think, yeah, since we're getting close to April, I'm gonna have to start scanning for more stocks. And thank you for all you guys that commented today. Some of your stock tickers that you bought. I like that. You got TRGP from Zhang Wei 3.0. Nice addition to my list of natural gas stocks. Look at uranium. Someone said yes. Ignit, yes. And then we have SOC, play for oil, another one from Zhang Wei. And look at YMM. That looked nice too. I'll have to look more into it from the Broke Genius. And nothing else. Yeah. Let's see. Nothing else. Anything else? Anything else? Good. Yeah. If you got some, yeah, I'll look into them. Okay. Later. Good night.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should. Feel like I should go.